Hello everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw, Senior Market Specialist at FXCM. My email address is rshaw@fxcm.com. Today is Tuesday. It's the 5th of April 2022. Just bringing up a high-risk investment morning. Sorry about yesterday. I logged in and it asked me for a verification code, and it gets sent to a mailbox I don't have access to. So it was a desperate race for me to get this verification code, and by the time I got it, unfortunately, our time had lapsed, so I'm begging your pardon. All right. Hey, Michael. Hey, Anna. Nice to have you on the webinars. Thank you, everyone, for joining. Yeah, and thank you very much. So I'm feeling definitely better this week. So thank you very much for asking. Hey, Raj. Good morning to you. Let's just bring up the market commentaries disclaimer. I'll keep this on screen for a few moments. All right, and I think we've got some interesting charts to look at this morning. I'll just bring up our references: MarketScope 2.0, CNBC.com, and we will be doing TradingView.com. Just to get us going, let's go through the headlines so that we know what the European article from CNBC is referencing. And it reads as follows. It says, European stocks set for tepid open, tracking global caution. And European markets are set for a muted open on Tuesday as global investors seek a catalyst, with eyes on the Ukraine-Russia conflict and economic indicators. Markets remain closely attuned to developments in Ukraine and prospects for central bank policy around the world in the face of surging inflation. The United States and Europe are considering new punitive sanctions against Russia after allegations of civilian killings in Ukraine, with Ukrainian President Vladimir Zelensky warning that more deaths are likely to be discovered in the towns recaptured from Russian forces. Reuters reported, citing a source familiar with the matter and a US Treasury spokesman, that Russia's latest sovereign bond coupon payments have been halted, with the US Treasury yet to authorize the payments for processing a corresponding bank, JP Morgan. The US is also expected to ask the US General Assembly to suspend Russia from the Human Rights Council. US Ambassador Linda Thomas-Greenfield said on Monday, after images emerged on Sunday of civilian bodies lining the streets in the recaptured town of Bucha on the outskirts of Kiev. Shares in Asia Pacific were mixed on Tuesday's trade, and the Reserve Bank of Australia kept its cash rate target unchanged. US stock futures were also flat in early pre-market trade-up. Investors bought the dip in technology shares following the recent weakness. If you take a look at the Aussie-US dollar, Aussie's actually flying this morning, so some hawkishness coming up there from the RBA. On the data front, a host of final PMI readings for March are due on Tuesday morning from on the data front, a host of PMI readings for March are due on Tuesday morning from across the Eurozone and the UK. Okay, so let's take a look and see what we have here. So I've been kind of thinking, as an analyst, where we headed for in the future. Of course, making these type of inferences are never going to be correct. You may get pretty close, but your assumptions are always based on assumptions, right? So it depends how good the assumptions are. So I'll put forward a sort of a hypothesis, and we can discuss it. So to start off with, we have here the participation rate. So I just wanted to bring this up. This is the US participation rate, which has been a lag. System's just not doing particularly well here. Let's just wait. All right. You can see that it's actually coming up quite strongly now. Okay, so what is the participation rate telling us? Well, it's certainly indicating that a lot of the discouraged workers, and the definition of a discouraged worker is a person that's so discouraged they're not even counted in the labor force. They're not even counted in the labor force because they're not looking for a job. They're not looking to be employed because they just are convinced that they're not going to find a job. Well, the fact that the labor force is moving up is obviously very positive in terms of the job market. Certainly, when I say positive, I'm talking very much in terms of the job market. There are clearly concerns elsewhere, but the fact that the participation rate is moving up is a core part of this hypothesis that I'm going to place before us. I wanted to see if we've got the unemployment rate here. Sorry guys, I don't know why it's battling. Anyway, we're going to bring this up. Unemployment rate here. So if this is U3, which is the most narrow, it should be around about 3.6%. Let's just see if that comes up. Yeah, 3.6%. Okay, so U6 is the broader definition. It doesn't really matter for this hypothesis. U6 will be coming down. In terms of U6, that would include underemployed and part-time, etc. So this is really excluding those type of employees. Nevertheless, we are at a very good 3.6% on U3. If I have to press all here, you know, we are pretty close to lows for the modern era. I mean, so in the 50s, we were smaller, we were lower, beg your pardon, in the 60s lower, but I'm not sure we can really compare as far back as that. I think 3.6, the Fed is pretty much suggesting that they are at full employment. What full employment is, it includes what we call the natural rate of unemployment. So it doesn't mean that everyone's got a job. There's always going to be a natural rate of unemployment in an economy, but including that, we're pretty close to full employment in terms of the US, with that participation rate ticking up. So I think we must acknowledge that the Fed is a dual mandated central bank. The second mandate is to get to this full employment, and I think that we always were concerned about labor market weakness. I think we can put that to the side for the time being. I think that the labor market's fairly strong. Okay, let's go into the next part of the theory. So I want to bring up the yield curve, and let's bring that up. So what we're doing is we're taking the US 10-year Treasury, and we subtracting from that the yield of the 2-year, and what we're getting here is an inverted yield curve. So this line here should be 0. Let me see if it is. Yeah, 0. Okay, so anytime we go below 0, we've effectively got an inversion. Think about it this way. Look at the actual series we're looking at. So we're taking the yield of the 10-year. So let's just say the yield is 5%. I'm just obviously just making up numbers here. So let's just say the yield is 5% for the 10-year, and let's say the yield for the 2-year is 6%. So it will be 5 minus 6%. That gives us -1. So there's an inversion. In other words, the shorter term note has a higher yield than the longer term note. Now that's when we bring up let's bring up Microsoft Paint here. That's basically an abnormal yield curve. So yield curves will tend to sort of look like this, kind of with a bit of a curvature to them. That's a positive sloping yield curve, and that makes sense. So you've got interest rate here, and you've got your term to maturity here, and theoretically speaking, you know, the longer the note or the bond, the more interest you would want for it, for a number of reasons. Number one, opportunity cost. You can take that money and put it to work in some other endeavor. So you want to be rewarded for giving your money to, in this case, the US government. So you want some sort of reward for the term, for the maturity. You want to be compensated for inflation, but what we've got here is something quite odd. Kind of got a curve that now looks like this. Sort of, it's actually started to invert. It's kind of looking. In other words, the higher yield is on the lower terms to maturity, and what that basically is telling us is that things are pretty good now, to the point that rates have to be increased now, but the prospects or the expectations for the future are bleaker. So that's effectively what a inverted yield curve is telling us. So perhaps it's suggesting that, you know, in the next sort of medium to long term, we start slowing down significantly, and dare we say, perhaps hit a recession. Now, having said all that, let's go back to our yield curve here. Let's build on the hypothesis. You know, what we're going to do here is we're going to throw in the S&P 500 as a proxy for the risk for global risk markets, right? So let's put that in. And what we've got to do here is we've actually got to change this to logarithmic just to make it a little easier to see what's going on. All right. Okay, here's the inversion. There's the first inversion. Here's the, we can put this one in, here's an inversion. Here's an inversion. Okay, let's just move this one a little bit more. Here's an inversion. Okay, so this is the global financial crisis inversion here. This is the inversion as we head into the tech wreck. Okay. Here's an inversion here, actually, just before COVID, funnily enough. All right. And we've got an inversion here. Okay, so if we take a look at this over here, this is actually quite a big decline in the grand scheme of things. So we kind of hit a high there. So they'll be looking at a monthly chart, and it comes down here, 1, 2, 3, 4. So sort of 5 months of pain here before we start moving up again. See where the next one is. This was, if I remember, this is the Asian currency crisis around about 98. So there's an inversion there coming into the tech crisis, global financial crisis, even before COVID. And now we've got another inversion here. So we must mention, in terms of the data that I have here, this looks quite, quite scary. So what what they say about inverted yield curves is that all recessions are preceded by inverted yield curves. Now, this is the important part, but not all inversions lead to a recession. So somewhere within this time series here, perhaps I'm not going back far enough, there have been inversions that don't lead to severe recessions, perhaps going back to 89 here, maybe one. So the point is, we can't forecast the future. We can't forecast the future. We can only make some sort of inferences, right? And hope that our assumptions are sensical. So what we've got to do, obviously, is come up with some sort of theory to what's happening right now with this current inversion. How do we make sense of this? So let's bring up another chart, and we'll bring up inflation. I'm actually at my office, so I don't know why this is sort of slowing. The internet connection here should be really fast. So anyways, nevertheless, we can see that the inflation rate is 7.9% on a headline basis. Now, I want to go back to what I said at the beginning, because it's really important. The Fed is a dual mandated central bank. The first mandate is what we call price stability. The second mandate is getting to that full employment. We've made the case that at 3.6% and an improving participation rate, the Fed is probably quite pleased with that. What they certainly cannot be pleased with is an inflation of 7.9%. Historically, they've kind of been targeting 2%. That was changed in August 2020 at the Jackson Hole Symposium to an average of 2%. But whichever measure you're using, the 7.9%, I think we can all agree that this is way too high in terms of target. Way too high in terms of target. Now, that brings up a credibility issue for the Federal Reserve, because they've got a mandate. They have got to hit their targets. They've got to get to full employment. They've got to manage the economy, and they've got to get price stability. And that effectively leads to a well-functioning financial system. So there's a bit of a credibility issue here that the Fed's battling with. And I'm not certain that it's fair to actually say that. I mean, the lockdown was an extremely rare event. We could call it a black swan, right? I mean, it's just nobody saw that coming before lockdown. So it was obviously a high stress situation. But what we can, I think, say with a fair amount of confidence is that the Fed is not happy with 7.9%, to the point that they are desperate to restore that credibility. They are desperate to restore that credibility. Okay, so given that they are at full employment or near those full employment levels, their attention is fully focused on price stability now, to the point that May we probably see 50 basis points come in. And I would suggest June probably has another 50 basis points as well. Okay, so there's going to be in my opinion, a fair amount of aggressiveness, and I want to just say subject to correction, because we can't forecast with any certainty. So the idea here is, I think there is a huge pressure on the Fed now just to restore that credibility. Now, well, one of the problems with inflation is that it can become self-fulfilling, and that can cause a spiral out of control. And I think that is very much the focus of the Fed now. So just to give you an idea of how that would work, if we all went into salary negotiations, we would tell the person that was interviewing us, like, look, inflation's up, you've got to raise my my wage just so that I can maintain a standard of living here. And you would say, I reckon inflation's at 8%. I need an 8%, and that's just to maintain where I'm at right now. And if that expectation goes to 9%, 10%, you know, it can become a spiral of expectation. So I think the Fed effectively wants to sort of get rid of that sort of risk as quickly as possible, and I think that that means that their focus now is on inflation as opposed to the employment part of their mandate, because employment is at that full employment level. What does that mean for the economy? This is where I think it gets really, really interesting, and whether it plays out this way or not is going to be exceptionally interesting to see. So I'm just going to draw in a couple of other charts here. I'm begging your pardon. I'll try sort of not get lost in the jargon here. But we have seen this before. This is just a basic economics model. You've got here, let's call this inflation, which is effectively the price stability part of the mandate. And on the x-axis, we're going to call this employment, okay, which is effectively the second mandate. And we're kind of here. So this is full employment. So full employment will be a fixed number. Okay, so you either add it or you're not. And let us say that we are, let's actually say that we're slightly beyond it. Okay, I think we can even make a case for that. So let's say that when we put in our forces of demand, this would be demand force, and this would be our supply force. So we've got market forces, right? Demand and supply. So where they intersect, we actually let's assume, and I don't think it would be a stretch to say this, that we are beyond perhaps the full employment level, or perhaps we could just call it beyond potential. But this gap here is what we call an inflationary gap. So once you go past your sort of optimal level on your x-axis, you actually are building inflation. And I think that would be a very good synopsis of where we were, say, in November, December last year. That's when the Federal Reserve Chair testified in front of the Senate Banking Committee saying, let's drop transitory. Okay, clearly transitory was not the right call here. So we're in this kind of inflationary gap. Now, what we're saying is, well, hang on a second. We've now got this conflict. Okay, so we've got this conflict. And what this conflict's done is it's actually pushed us, it's pushed our supply up. And I'm just going to exaggerate this for the sake of this example. And we'll call this adjusted supply due to conflict. Okay, and that would be already, you can see the higher oil prices, the higher wheat prices. I think wheat's up 12% since the conflict began. So we've got the supply crunch. Now, let's just ignore that for a moment. Sorry, let's come back to that. Let's just go back to the Fed. The Fed now wants to control inflation above target. It wants to get, so the Fed wants to get back to target. So what it will do, it's now starting to increase interest. Interest suffocates demand to a degree, okay? And now, in our example, they are at sort of, let's say this is inflation, this is target, so they're at inflation target, and they are at full employment, and this probably was the plan November, December last year, okay? But now, as we said, but wait a second, that's not how the world's operating at the moment. We've actually got this big, let's change this to blue, got this big supply, supply shift. So what's the supply shift actually done? It's pushed inflation even higher above target. Now, at the moment, the job data does suggest we're at full employment. So I've just, I have sort of emphasized, I've over pushed the supply, because I want to show you once the Fed, okay, once the Fed starts, I've done this incorrect. Okay, we're actually over here. Okay, so the Fed, we're at demand force 1. So this is now what the supply shock has done. It's put us over there. I beg your pardon. Now, once the Fed starts cutting aggressively, what they're actually doing, okay, is they're going to start moving the price back down to target. Okay. So they want to eventually get to this level here. Okay, so they're trying to get back to target. But in doing so, they're putting huge pressure on the x-axis, because the x-axis is pushing to the left. So I know there's a lot of drawings here and a lot of moving parts, but effectively, I'll try to put it, we started off here before the conflict. We get pushed here to the conflict, and now the Fed needs to either control inflation or employment. But we've said they're quite satisfied with employment. They're completely focused now on inflation. So they're going to fight inflation primarily. So they're going to push us here. Okay, so that's where we're going to. So we've moved effectively. We've effectively moved from green to purple, and then the Fed possibly looking to take us back to red in terms of the ellipses. And they're doing that because they see that 7.9% inflation is just too much of a credibility issue. At the same time, they, in my opinion, are viewing employment as relatively strong. So what I think is happening here, okay, and this is a big inference, okay, whether I think the Fed knows that it can either work for inflation or it could work for employment. It doesn't have to work for employment. We're at that kind of area that it's happy with. So we're going to move it inflation. In other words, it's going to induce a slowdown to the point that we're probably going to border on a recession. In other words, the Fed is actively, knowingly inducing recessionary pressures because of the supply movement here. And I think they're okay with that. I think they're okay with that. This is the big deal. In other words, okay, the fact that the labor market is so strong, they are calculating that any sort of recession is going to be mild. And so they're going to focus on inflation. The big caveat here for us is, well, are they perhaps underestimating this risk of recession? Are they underestimating the risk of recession? And that we're going to have to wait and see, because when we go back to our yield curve, okay, we know that that inverted yield curve does cause does suggest that there is going to be these disruptions in the global risk markets. And I think that's where we are at the moment, which of course now brings us to our charts. So let me just bring in a chart, because we haven't really examined any charts this morning. So let's take a look and see what's happening in the financial markets, and then we can close up for the morning. If there's any questions, just go ahead and type those through. let me just start off with DAX here. All right, so we want to see the DAX now is rolling over. The DAX is rolling over, and we already read the headlines this morning saying that the market is it's very tentative, watching these developments. We've looked at what happens after an inverted yield curve, and I've put forward a suggestion that perhaps controlling the inflation is the lesser of the two sort of evils, but the markets may sort of start reacting on that. So we want to just keep an eye on this. Remember what we've got here. Is this a bear market rally? Okay, so last week's candle is an inverted hammer, so there is some resistance. Is this that bear market rally? If it's a bear market rally, that's where the pain is caused. Okay, let's just take a look what happened on the Dow yesterday. I'm looking at the Dow because there was an article I put out yesterday that potentially it may be it may be sort of a buy the dip, but I'm not sure that's the case. It actually looks like it's rolling over on the hourly here. So you can see that the markets certainly are nervous, and the inversion here, I think, is a big concern for us given previous ways the market has reacted. It's very important for us to not get anchored in that scenario, because the dynamics are very different this time. We've kind of got this conflict which is causing supply shocks, which is causing stagflationary pressures, which is different to other times. So I'm not sure if the relationship between the inversion and the stock market remains, etc. But we're going to have to watch that. Every recession has an inversion. Not every inversion has a recession. So I think that's what I wanted to introduce to you guys this morning. The possibility that the Fed is kind of caught in between a rock and a hard place. What do? Well, they've got to, I think, restore credibility. The job market is fairly strong. Because it's so strong, I think they're calculating on a milder reaction to the higher rates. Hey Jan, morning to you. I think they are hoping that, I think they would be very much aware that an aggressive hike is going to put pressure on the economy. They're just hoping that because the employment situation is so strong, it offers a cushion or some sort of resilience. Any questions around that? Please go ahead and sorry, Pete, I just missed your. The DAX hit the 148 area, major resistance. Yeah. So just going back to the DAX, sorry, I just saw that now, Pete. So Peter is just saying that technically we might be at a resistance area, and that's exactly kind of the bear market. If that resistance holds up, well, that's that bear market rally, isn't it, Pete? So what would make me feel a lot better, just incidentally, as a technical analyst, would be a higher trough followed by a higher peak. But I'm not sure we're going to get that. We may get a lower peak. We may get something like this, and then kind of another capitulation down. I mean, it's very tricky times. So that resistance level, I would suggest, is probably a key level to keep an eye on, Pete. Let's just see how that plays out. You can see major resistance based on last week's candle and this inversion. Okay, so we only inverted on Friday. I think we came pretty close on Thursday, but I think the real inversion happened on Friday. Well, now we're gonna have to watch that. By the way, the timing between, say, an inversion and when the S&P, if it capitulates, it's different each time. Sometimes it takes a long time before there's a capitulation. Okay, so yeah, just asking, why is the FTSE doing better? Let's bring that up. Sorry, I'm so used to typing UK oil. Let's just go UK 100. Okay, let's just take a look at this here. All right, so I've just got these side by side. Yeah, there's no doubt about it that the FTSE is outperforming. I would suggest, obviously, the composition of the index is a major factor there. And for example, I haven't looked at it, but Royal Dutch Shell is a huge component of UK 100. I think there is a fair amount of commodity representation in the FTSE, and I suggest that's probably the outperformance there. We do have Royal Dutch selling here. I think let's just look at this way actually. Yeah, and it says, so the UK has got the oil, the DAX is your manufacturers. So I think that the UK 100 is got a much larger representation in terms of the commodities. So there's your outperformance there. This is still very slow, so but I think that's I'm fairly comfortable. That's the explanation. However, having said that, okay, the UK 100 still looks interesting to the point that it's coming right into this resistance area here. So just like Pete's got the resistance at sort of 148 on the DAX. Now I think there's 7.6 on the FTSE 100 is something for us to watch. So both indexes are heading into that resistance area. Now, if the commodities continue to perform, and if we get some sort of higher trough, higher peak, I think that's a sort of a good-looking pattern. The idea here is, though, if the markets do capitulate due to the inversion, let's just assume, okay, and this is an assumption, so we don't know if this is what's going to happen, but if we assume that the inversion does lead to some sort of capitulation, and again, I want to stress the timing of that capitulation is different every time there's an inversion, and it might be different this time, right? If that happens, then the correlation coefficients for all sectors of the market tend to 1. They tend to sync up. What am I saying there? I'm saying that if we do go into some sort of recessionary pull, and you do see the DAX pushing down, even though the FTSE has got a large commodity component to it, what tends to happen in bear markets is they all lock up, and they all move in a similar direction. Again, I'm not saying this is what is going to happen. It's just the hypothesis we've put forward today. We've gone through all the charts suggesting that that inversion is very, very much a worry. We've also suggested the Fed has to restore credibility. It may force the recession just to restore that credibility. That may hit all risk markets. If they start taking strain, they tend to lock up towards a correlation of 1. So it's going to be a very interesting market, to say the very least. Any other comments there? Please type those in. All right. I think what we'll do then is let's conclude at this point. You guys, of course, are welcome to email me, and I look forward to speaking with you tomorrow. Thank you very much for joining this morning. As always, highly appreciated.